All right, guys. So Steve Budzik here. Welcome back from My Candy Realty. And I have the one and only Mick from Novus Mortgage, an amazing lender that wanted to share. He actually called me a week ago and really wanted to share some of the new cool programs that he has for, retail agents or agents that are working with investors. So Mick, I'll let you kick it off and take it from here.
Good morning. Good morning, Steve. Thank you so much for the invitation. I'm very excited to be here and to share some information. Real quick, Novus, we are a federal bank owned by Ixonia Bank up in Wisconsin. So under their federal umbrella, we can write throughout the whole country, except a couple states where we don't have, it just doesn't work. California's hard, but we write in California. Alaska, we don't write in Alaska or Hawaii. New York has some overlays that keep us out, but generally speaking, right here in Illinois, we're based in Wisconsin. We have branches here in Illinois, and we write a lot in Indiana, as a lot of realtors have clients moving out of Illinois. Yeah. We write a lot in Florida. We actually have physical branches in Florida as well. So anybody who's looking to do real estate right here in the Chicagoland area, or outside of Illinois, we can handle that. So it's nice to be a part of that. Thank you very much. I'm very excited to be here. Novus means new in Latin. We have a long history of our CEOs and our people involved in the company being in the mortgage industry for a long time. So it's not just a bunch of new players, it's a new way of looking at mortgages. Our whole philosophy is that through technology, we can become efficient and be more responsive to the buyer. One of the wonderful things that we have, and you've been a part of that, is the technology we're doing today. This is not anything unusual for us at Novus. You can go and scour some of the social media. You'll see a lot of our people are posting and doing unique videos and unique content. So we're trying to be very responsive, not only with technology, but in the recent tragedy of COVID. People who've been sick and died, they're still buying houses. It was a wonderful last 2 years for real estate. Rates were really good, opportunities were there for people, and we were able to do a lot of business for people and to be a help for them. But the purpose of today is, in a changing market, we have some new products that I'd like to introduce to you. One of those, and you're so wonderfully young, you may not remember back in the day, there was a no documentation loan. If you remember, the four basic parts to a loan are income, credit, cash, and collateral. So if you take a look at when a lender has to verify all these things, it's really a check verification recheck of, you told us you make $2,000 a month. We're going to check with your pay stubs. We're going to recheck with a W-2, and we're going to verify it with a VOE, or a verification of employment. So lending is nothing more than, you tell us what you're doing, and we're going to verify that you're doing, and then that meets a parameter, or the ball fits the circle, or we're in the orbit of something that you can get borrow money for to get keys. The ultimate goal, again, being keys. So when we talk about a no documentation loan, what we're looking at basically is people who tend to take a lot of income off of their taxes. Self-employed people who, rather than work on their gross receipts as a taxable income, start deducting their telephones, their cars, their restaurant when they're out to eat. People who are on a W-2 program, a regular paycheck, they don't get the benefit of those deductions. But at the same time, they also don't have the risk of being self-employed. So, it's a risk balance. Self-employed people, they do get the benefit of that, but then they have the risk. So there's a benefit to take all that. But what does that do? With those deductions, it reduces all of their income, so that instead of paying a large percentage of their income for Social Security, because they're paying a higher percentage, there's no employer contribution for your Social Security. Self-employed person pays all of it, the company side and the personal side. So the plan of action for most self-employed people is to reduce their tax liability. When they reduce their tax liability, they reduce their income. So with the no doc loan, what we do is we look just for a credit score and a lot of money in the bank. and we forget the fact that they need to make regular income, and that the collateral or their credit is what it is. So when we take a look at that, we're looking for a credit score. It starts about 660. So if you have a credit score of 660 and a lot of money in the bank, we don't care if you're jobbed.
Nice. What's a lot in ratio? Let's say a $300,000 house.
So if you have a low credit score, then you have to have more skin in the game, and we're talking about 40%.
Got it.
Right.
So 40% cash in the bank.
Right. And if you have a 740 credit score, we will do that loan for as little as 15% down payment, which is less than a conventional loan. Right. So again, the higher the credit score, the better you've behaved in the past with your credit, the better history you have of showing that you're good at what you're doing, managing money, keeping all the balls in the air, doing things successfully. The better rates you'll have the opportunity for, and also the less down payment, less skin in the game. So I like to say, in general terms, if you have a 720 or above, it's 20% down payment. So on a home that's, let's say, $400,000, 20% of 100 is 20 times 4. You need $160,000 if you have a credit score of 720. They're also looking for 3 months savings or 3 months in reserve. So if your principal and your interest is $2,000, your payment's $2,000, they want to have another $6,000 in the bank at the time of closing when they're verifying the loan. 2 months later, 3 months later, you need to move that money to something else. No one's coming back to look back at what you're doing, but to set it up, you do that. So take a look, and in our area, in this Orland Park, Frankfort, Tinley, Lincoln Way area, we have a lot of people that have small businesses.
Yep.
It's a good opportunity for them to be involved in real estate as a self-employed borrower.
Yeah,
really
that's awesome.
Really a neat program. And the rates aren't too crazy. They're about a point and a quarter higher than what the current market rate would be.
Okay. Which is, what are we floating today? Like 4.6, 4.7, or?
We're a little bit higher today. We're like 4 7/8, right about, we were touching 5, bouncing over 5 last week, down to 4 3/4. That's a good question about rate. Can I lead into the next segment?
Yeah.
So everybody says, what's the best rate? And I don't want to be sarcastic, but I really want to say the best rate is 0%. And how do you have 0%? You aren't borrowing any money, right?
It's true.
And after that, it's all based on risk. So the banks have been involved in lending for eons and eons, and you and I are just a one-time borrower. We don't have that long-term history. So throughout all the research and everybody who's been involved in lending money, they've set up traditional parameters. And what they look at is how you behave with credit in the past, your credit history, your credit score. What is your income? Because you have to service debt. Today, they figure that the riskiest loan is about 50% of your debt service to income. So real easy math, on a monthly basis, your monthly payments, if you make $10,000 a month, in round figures, you can afford $5,000 a month in debt. So if you have $5,000 in debt, that includes student loans, alimony, child support, housing, credit cards, and other installment loans you may have co-signed for. So of that $10,000 you make monthly, $5,000 of it is for debt service. And now you start to whittle in a housing payment in there. So if you carry in an $800 car and you've got $150,000 in student loans, now you see how that debt to income ratio is kind of there, because we want you to have the ability to have money to live. And beyond just covering your debt, you've got to be able to live. You need groceries, you need your utilities, a vacation or two, clothing, things of that sort. So that's the second aspect, is what is your capacity, your credit. Then the other thing is, the more skin in the game, as we talked earlier, your down payment, the less risk you are. And you've heard something like private mortgage insurance, or PI or PMI. That's a way that the bank has an insurance policy that you, the borrower, pay in case of a foreclosure. and we do remember the 2008, 9, 10, 11, 12 years, that was very, very interesting because it was just a very small percentage of the people went belly up. And if you take a look at, you miss one mortgage payment and then you try and make it up, it's very hard if you're living anything close to the edge, really, really close. So 3 missed or partial payments puts you in the foreclosure situation. So if you're real tight and you're at that 50% loan or debt to income, and all of a sudden you have an emergency where a car needs fixed, or God forbid somebody's hurt and you need to go to the hospital, and your bills are needed to go elsewhere instead of to your mortgage, really it's only 3 payments and now you're in risk. So that's really tight. So what the banks have done through their history, through their study, what they've been involved with is that 20% is about where a bank can take a property back, unfortunately, and make themselves good. So PMI, that private mortgage insurance, goes away if you put down more than 20%. But let's take a look at it. There's really no safety net then for the bank at 20%. So that 20% actually has a higher rate than 15% or 25%, because there's no protection right there. So if a borrower puts down 25 or 30 or 40%, there's more skin in the game, you get the best rate. Then the next thing is the collateral or the property. And this is often forgotten until there's a title issue. I've got one closing right now where there's an issue on title. There's an old mechanics lien. Somebody didn't pay the plumber 5 years ago, and it showed up in court that he filed a lien against the property. So the current owner has to go back and pay the plumber. Or the title company won't release a clear title. So the collateral is real important, and you know that because you've been involved. You've got skin in the game with tool belts, and you understand everybody needs to get paid. So when you ask about what is the best rate is low debt to income or high monthly income, and then low bills, credit scores near 800, and over 25% down payment. How many scenarios do we have walking in like that? Not a lot. There aren't people that really are doing that. So everything else is then a moving calculus. You try and align the 4 things to get them together to work, and you come up with a rate, and that's kind of where rates are about today, at 4 3/4 to 5 in that range, depending on who's borrowing and what their situation is. A little plug, and maybe you're starting to run into this with the collateral issue and condominiums. In Florida last year, unfortunately, people lost their lives when that condo project collapsed near Miami, right? We also had a situation in Oak Park where they evicted the whole building because of structural issues. This was last fall. There was another one up in the Wisconsin area where they had to evict people because of structural issues. When you look at the government securing loans, you as a realtor, the seller, the attorneys, they go to the closing table, they sign their documents, they wonderfully are happy to have served the client, they leave, they're done. However, the bank is holding that paper for 30 years. So we want to make sure the collateral is worthwhile over the 30-year course. So if it's a dilapidated building and it doesn't have a lifeline of 30 years, we're not going to lend on it. What we're finding and what we have found, and as evidence is shown, that condominium people aren't doing their maintenance, right? Their deferred maintenance isn't happening, or they don't have the budget, or they haven't done anything. So one piece of advice for any of the realtors out there doing condominium deals, there's a new condominium questionnaire that's out that specifically asks if you've had a structural report. Have you had a certified engineer or a certified architect come out to look at the physical structure of the building? And a lot of homeowners associations don't want to sign off on this because sometimes you bury your head in the sand, you don't know. Sometimes they're overwhelmed by the information. Sometimes it's where my mom lives. There's some do-gooders that live in the neighborhood that voluntold. They're voluntold they're going to be on the board. So they're on the board, and the next thing that happens is, what do you mean we need to do certified engineers and structural programs, and we can't do all these things? So as no fault of the association. They just kind of don't know. But we at the bank and you, the realtor, want to know that your client's going to be able to live in a home in 10 years and it's not going to fall down. So if you're doing any condominium deals, allow yourself a little more time to work through this new questionnaire that came out January 1st. We all kind of knew it was coming in the fall, but now once it hit the skids, it's a deal breaker for some people.
Okay.
It's stopping. The consequence would be an uneducated lender will lend the money. They'll sell their money to the government. The government will audit the file, and then they'll make the lender buy that loan back. And then all of a sudden, the lender's out of money to lend in the fall. So some of those people who don't understand or don't know the process will get stuck in the future having an issue come up.
And a question on that, is that across the board, all lenders have to follow that guideline in terms of that condo questionnaire?
Great question. If your lender sells that loan back to the government, then they have to follow that questionnaire.
Got it.
If they portfolio the loan, if they keep that within their own bundle of money, then they don't have to worry about it. So it's a federal guideline. Again, if they're selling that loan back to the government, it's a government guideline.
Okay.
So one of the neat programs we also have besides the NoDoc is our fix and flip loan program. Oh my gosh, what a wonderful program to have. It's just so cool for somebody who wants to be a real estate investor, somebody who wants to get involved in real estate and kind of doesn't know how. And I say there are two things you need to know in order to be a good real estate investor. You got to keep your taxes good. You got to do your tax forms. You got to be friends with your accountant. You've got to do it every quarter. You can't let it get behind, because that opens the door for financing. Steve, who's got $500,000 in their pocket? Not many people. So yeah. Unfortunately, they got to come for financing. And on the corporate side, it's all about what have you done tax-wise. So if you can keep your taxes in shape, if you can do them on every project, hopefully you have people out there that are doing, a project a month, a project every other month, one every quarter, one every 6 months, one a year. It still has to show up with experience, because with experience, the numbers get better. Your rates get better, your down payment gets less. Skin in the game is less because you've acquired wisdom and knowledge through your previous deals. So on this fix and flip program, we will go to 20% equity involvement on the purchase. You're buying easy math, you're buying a $100,000 home. You need to have 20% or $20,000 on the purchase. Then they will also fund 20% on the improvement. I'm sorry, they'll require a 20% equity involvement on the purchase. One more time, let's try that again. They'll do a 20% involvement on the improvement. So your homework as a realtor and an investor is to say, I've got this collateral, I've got this house, we want to graze and granite it. So we're going to do kitchens, we're going to do bathrooms, we're going to do a roof for airtight, watertight, we're going to do windows, and we're going to do flooring. And all of that's going to total $50,000. 20% of 50 is $10,000.
Gotcha.
So you have to show the 20,000 on the purchase for 100, and you have to show 10,000 for the improvement on the 50. So you have to show $30,000 in the bank. You go to closing, you pay the 20,000 on the purchase, the 30,000 on the improvement. The bank then, like a normal closing, gives you keys, you sign the title, you sign the mortgage document. It's a 1-year loan. You get 1 year to do the improvements. And throughout that time, if you are improving and you need money for the cabinets and the window guy is done and the roof guy is done, based on your contractor statement or your sworn statement or your budget, you call up us and you say, okay, I'm ready for that 50,000. I need 30,000 because I've paid the plumber, the electric, the roofer, and we send an inspector out to verify, yes, the roof's done, yes, the windows are done, yes, everything is permitted, and I see that it's all checked out and the permit was approved, then we kind of issue that $30,000 draw.
Nice.
You, the manager of the project, the owner, the builder, whichever, goes out and then cuts the checks to the subs. And at the same time, remember those liens, those mechanic liens, make sure you've got all your paperwork lined up good. You finish the project, you take the other $20,000 as his draw because everything's finished. In 4 months, the project is done. What do you do with the other 8 months? Well, maybe you want to sell it and you put it on the market and you sell it, and then that loan gets paid off. And now you have a fix and a flip.
Nice.
Let's say you fall in love with the project. You love the house. The neighbor comes over and says, oh my gosh, can we rent this house from you? And you're like, what do I do? What do I do? I got a 1-year loan. How do I exit this loan? So we have what we call a debt service cover ratio loan, DSCR. It's an investor loan, right? And you're familiar with the term DSCR.
Mm-hmm.
So what they do is they take all of the principal, interest, taxes, insurance, and they put it in one number and they divide it by the rent. And if that ratio is 1 or better, then it's a good property. So how do you determine the principal, interest, taxes, and insurance? You backpedal on the math. You call Mick, you say, Mick, what's the rent? What's the debt service cover ratio? We do that. So I have an example here. Let's say that you have a property after your fix and flip, you bought it for 100, you put 50 into it, it's worth $150,000. You rent the place for 1,500. You can get a loan and do a cash out up to 30%, or you can get a loan on that $150,000 property for about $103,000. So you can take about 30% of your equity out. 100 grand allows you to do the next project and the next project and the next project, and you can pay yourself what you did in there. However, when we look at what the payment is for a $100,000 loan, principal, interest, and taxes, it's about $1,300. So 1,500 is better than 1,300. 1,500 rent is better than the 1,300 PITI. So now you're above 1, and that's a lendable loan on the debt service cover ratio product.
Okay.
The limiting issue is that 30%. So they do both. It's 30% and at the same time, no less than 1% on the debt service cover ratio. So it allows you as a realtor, builder, fixer, flipper to say, hey, I put originally, what'd you put into the house? $30,000. Through your hard work and your efforts and the rent, now you get your $30,000 back, plus you get $70,000 in equity, and you're about $200 positive on your rent every month.
Nice. Okay.
Real nice
Cool.
program.
Yeah.
So we have 2 options for that, right? So the one is the fix and flip, where you can buy it on a 12-year interest-only loan, 20% equity on the purchase, 20% equity on the improvement. We have 2 exit strategies. One is you sell it within 12 months and you just take the cash difference on the loan. The second is, I want to be a real estate magnet. I love this property. I've got it rented. It's good people. We're gonna rent it, and that is the debt service cover ratio product.
Okay. What's the interest rate on the fix and flip loan, roughly?
So we're closing one tomorrow that we quoted 3 weeks ago, and he's at 4.5. But 3 weeks ago, regular rates were at 4.25. So it's pretty close to what the prime rate is, or what the good rate is today. I would expect today it would be about 5.25 on that debt or on the fix and flip rate, about 5.25.
And then if you did say you fell in love with it, neighbor wants to rent it, are you guys converting that then to a 30-year fixed, or?
That's the 30-year debt service cover ratio loan. It's
Got it.
The valuation, the value of that loan is 30% equity or 1 on the debt service cover ratio. And that's a 30-year amortized, full 30-year loan amortized all the way down to zero. So you don't have to refi unless you find yourself in a better interest rate position or a better equity position and you want to pull out. So the trouble for some investors a couple years ago was that on the commercial side, investment properties were only being financed for 3 or 5 years. And every 5 years, you had to refi because they weren't termed out at 30 years. This is a 30-year paid off loan. Wonderful.
How many of these loans could you have under your personal name or LLC at one time?
So you can do an unlimited number under your company.
Got it.
This one company will do 10.
Got it.
And then as a bank, we also have a relationship. We have buddies, we have partners, we have people we've pre-approved that we want to go out to dinner with. We call those broker lenders. So we have 3 other broker lenders that will each do 10 of those.
Oh, wow. Okay.
So under Mix Novus umbrella, I can do 30 debt service cover ratio, commercial 30-year amortized loans for single family.
Okay.
Non-owner occupied rentals.
Nice. Awesome. That's super cool. And is that rate still on the 30-year? It's still that 5.25 if you were to do it today per se?
Ishes. Yeah. 5.25 ish. You know?
Yeah, exactly.
It's based, again, your credit score goes into it. What have you put into it? And if you're taking all 30% out, it's a little riskier. If you're only doing 50% loan to value, it's less risk, right? There's more skin in the game. So it again, ish.
Okay. All right, cool. That's awesome. And is there any seasoning on that? Let's say you did the fix and flip and you got it done in 2 months, right? You hammered through it and you got a renter on the 3rd month. Is there a 6-month seasoning?
No, it's meant to be. Yeah. Get it done.
Yeah.
Done and off the books. On to the next one, and then spend an hour with your accountant and make sure the books are good so that come next April, it's easy peasy.
That's awesome.
No, I mean,
that's really cool.
Very seriously, you will only be as successful in investing as your tax returns are and you have access to financing.
Yeah, totally agree. And good contractors, but the other 2 first.
Call Steve Budzik. He's the best.
Yeah. That's cool. That's awesome. So those are some really cool programs. I like that. That really opens the door for a lot of people to A, get started on a fix and flip, or B, if they have, if you're a conventional type real estate broker, you can really start to work with these small business owners as buyers. If they don't have, if they're not reporting all of their income. And I don't want to say not reporting, but let's be honest that everybody's playing the same game to lower how much they pay in income tax, but yet obviously still show that they make money.
Tax minimization is not illegal. Tax avoidance is.
Yeah.
So there are laws, but again, the business owner, he takes risks. She takes risks to be 100%. In business. And people rely upon them and there's nervousness. I've got some entrepreneurs in my family and, did it age them? Did it gray them? Did they enjoy trips to Florida at the same time? Yeah, it did. But you're always thinking 24/7 about the responsibilities of other people when you're a business owner.
Exactly. Well, that's super cool. You touched on a lot of honestly key, really cool programs. And the biggest question that and I always hear, what's the rate? What's the rate? So that was a good breakdown and explanation. I like that. Anything else that you want to share?
So if you have a bundle of your realtor friends and partners that are struggling in today's market to get their buyers homes, we have a program we call Certified Credit Approval, where we fully underwrite the program for credit, for income, and for cash or collateral. We take a look and we send that file all the way through. And if you're a seller, what did I like when I was selling my fix and flips and I was doing my real estate? I love somebody walking in with cash, right? Because with a cash buyer, there's generally no appraisal and you don't worry about the inspections. After that, you now start to compromise your position. So with our certified credit approval, our CCA, there's no compromise for the buyer because financing has already been taken care of. We've already looked at everything. We say at Novus that that buyer is the next best thing to cash, right? Because if there's a condition that shows up on underwriting, we've already cleared it. Hey, can you please explain how is it you had a 2-month gap in your job history? Mr. Borrower, could you please explain how all of a sudden you had a large deposit into your savings account that is double your monthly paycheck? Where did that money come from? We ask those questions in that underwriting process and we get those answers. So when we issue that clear to close without a property, they're golden. We can generally do that loan in less than 30 days. You know, the managers higher up at Novus say 21 days. I say, let's not make the stress, but if you need to say 21 days, we could do 21 days on a CCA.
Nice.
Because they're there. It's a beautiful program. It eliminates the stress. Steve, oh my gosh, you know, it's stressful enough coordinating all of the improvements that need to be done, to coordinate all of the inspections that need to be done. For the buyer, they're freaking out. If we can eliminate that stress, that tension of that contract and the time frame of it and put it on the back burner because we've already done it, my goodness, you already have to turn the paperwork in. Do it ahead of time. We love the ease of it. You know, it's not anything unusual. We're going to need your bank statements. We're going to need your paycheck. We're going to need your taxes. Give them to me early, you know.
100%. I wish more lenders operated in that manner with their clients because that's what causes the delays and that's what makes the upset seller and buyer. And as you said, the stress. So super, super important.
Yeah. Again, as a past investor, I hated when deals blew up. You know, it cost me money because the house was another 2 months on taxes, the liability of being broken into, all of those things were played into a factor when a deal blows up.
Yeah.
But we can eliminate that by doing this all ahead of time.
I love it. I love it. Well, I appreciate all that info, Mick. And if somebody wants to reach out to you, how would they do so?
The best way is a text or a phone call, 708-220-5464. And you can Google me at Mick Kenes, Kenes, at novushomemortgage.com. You can find me. We're here, Novus. Our branch is right here in Orland. Yeah, we have a physical branch, but 99% of our stuff is done on technology.
Yep. Cool. Well, I love it. I'll for sure include a link. I mean, this will be on YouTube and all over social media. So make sure you guys pay attention to in the description. I will again put Mick's contact info with a link so that you can get in touch with him. And any questions at all, that's what I love about you is you're so willing to talk to anybody wherever they're at in the process or any questions that they have. So I know that was super helpful for me. And with all the new programs, right, we're talking about these programs today, but in 6 months, in a year, in 2 years, in 3 months, there might be new programs, which there probably will be. So call Mick, because if these programs don't work for you, I know that he will have other programs that do.
Oh my gosh, thank you. And just a preview, we've got some secret sauce working with regard to second homes and vacation homes. And that's going to be really interesting because the government's coming with some LLPAs, loan level price adjustments. And we're going to work around for that. So stay in tune.
Cool. Well, thanks, Mick. I appreciate everything and see you soon.
Thank you very much, Steve. Thank you. I sincerely appreciate the opportunity.
Absolutely.